So, Taylor, we just discussed the panic seller, someone who lets their emotions get the better of them during market downturns. Now, let's flip the script and talk about a different kind of emotional investor, the FOMO investor. Imagine someone constantly scrolling through social media, seeing friends bragging about their incredible investment returns in the latest hot stock or cryptocurrency. They feel that pang of FOMO, the fear of missing out, and jump into the investment without doing their due diligence. This is our FOMO investor, and their story often doesn't end well, sometimes jeopardizing their long term financial goals like retirement savings. Sam, what are your thoughts on this all too common scenario?
It's a classic example of how emotional decision making can derail even the best laid financial plans. As humans, we're wired to react to social cues, and the fear of missing out is a powerful motivator. The problem is, investing based on emotions, particularly FOMO, often leads to chasing performance, buying high and selling low, the exact opposite of what sound investment principles dictate.
That makes sense. I've definitely felt that FOMO pressure scrolling through Instagram. Everyone seems to be getting rich quick, except me. How can we avoid falling into this trap? Alex, you asked earlier, how can investors avoid the fear of missing out FOMO when making investment decisions?
A great place to start is by understanding your own risk tolerance and investment goals. Are you investing for retirement in 20 years? Or are you saving for a down payment on a house in 5? Having a clear goal in mind helps you filter out the noise and focus on investments aligned with your timeline and risk profile. This echoes the reap the benefits of compound growth without emotional interference point from the article, Taylor. Remember that one?
Yes, the article mentioned how important it is to have an objective perspective, especially when markets are volatile. This reminds me of what we discussed last week about diversification. Isn't that also a key part of avoiding FOMO?
Absolutely. Diversification is a cornerstone of sound investing. By spreading your investments across different asset classes, you reduce your overall risk. If one investment underperforms, others can cushion the blow. It's like the old adage, don't put all your eggs in one basket. Diversification helps protect you from the emotional roller coaster of chasing individual hot stocks.
Let's say someone sees a cryptocurrency skyrocketing on social media. Instead of pouring all their savings into it, a diversified approach might involve allocating a small, predetermined percentage of their portfolio to alternative investments. This allows for some exposure to potential high growth areas while limiting the downside risk.
So, if I understand correctly, setting clear goals and diversifying are two key strategies to combat FOMO. But what about the role of social media itself? Your other question, Alex, was what role does social media play in shaping investment behavior?
Social media can be a double-edged sword. While it can be a source of information, it's also a breeding ground for misinformation and hype. It's crucial to be critical of what you see online and not take everything at face value. Remember, people are more likely to share their wins than their losses, creating a distorted view of reality.
Exactly, Sam. Think of it like a highlight reel. You're only seeing the best moments, not the struggles and setbacks. This can fuel FOMO and lead to unrealistic expectations. So, to recap our discussion on the FOMO investor, understanding your risk tolerance, setting clear investment goals, diversifying your portfolio, and being critical of social media hype are crucial for avoiding emotional investment decisions. Don't let the fear of missing out drive your investment strategy.
That's a really helpful takeaway. I'm definitely going to rethink how I engage with financial information on social media.